Hi everybody, thanks for joining me on my little YouTube corner of the internet as it were. In this video I'm just going to talk about a couple of little articles in the most recent Financial Times weekend supplements as it were. One is by Michael Mackenzie, who's absolutely brilliant. He writes an article called The Long View, and this one is entitled Equity Investors Need Not Worry About Rising Interest Rates, which is a good one. With him actually I usually find that I have to read his articles about 3 or 4 times before I fully grasp what he's saying, because his writing is brilliant, but it is really quite detailed, and it does take a little bit of brain power just to sort of figure out what he's saying. And the other one, again, a very good article by Chris Dillow from the Investors Chronicle, also in the Financial Times supplement, the money section in the Financial Times at the weekend, and that was dated the 20th of February. In fact, they're both dated the 20th of February. Anyway, this article by Chris Dillow is entitled The US Inflation Danger. So they're both talking about interest rates and inflation, and I thought, well, I'd combine the two really, because interest rates and inflation are very closely linked. Why is that the case? Well, bond prices are really dictated to by the expectation in the short run and in the long term as to what's happening with interest rates. So it's really seen as a proxy to inflation, because one of the main weapons that central banks have against inflation is to stick up interest rates. So you can imagine the economy is running away a little bit, it's getting a bit overheated. What do? You stick up interest rates just to increase the cost of borrowing, and it just cools everything down a little bit. That can also be seen in reverse, of course, as it has been in the last year or two, where the economies have been absolutely tanking because of coronavirus. What do? You lower interest rates, print more money, all that kind of thing, just to sort of see if you can stimulate that economy a little bit, because it's suffered so badly in the past. So this is they're coming from a slightly different angle. Chris Dillow here is talking about short-term bond prices, short-dated bond prices, and therefore short-term inflation expectations. And his is quite interesting because he talks about why inflation might be ticking up anyway, not least because of the $1.9 trillion stimulus package that President Biden is going to pump into the US economy. That certainly will have an inflationary pressure. Of course, if you put more money into the system, you just basically make the dollar worth less than it did before, and by definition that is inflation. But he was saying that one of the key indicators as to why he thinks that inflation isn't far away is when he compares conventional bonds, that's just normal, short-dated bonds which might expire in 2, 3, 5 years or so, against inflation-proofed index-linked bonds. And he's pointing to a 2.3 percentage gap, which is a 10-year high. Now that $1.9 trillion stimulus is the equivalent of 9% of GDP. It's a huge stimulus package, absolutely massive. So the Federal Reserve, is now targeting inflation above 2%, which the easy solution is to stick up short-term interest rates. But there lies the danger, because why would you put money into relatively high risk assets like shares that yield, say, 3.5%, something like that, when you can get absolutely cast iron guaranteed returns in the bond market at roughly the same yield? That reach for yield, which over the last year pumped trillions of pounds into equities, now could just have the same effect by flowing into bonds. And bond prices are rising, and so money is shifting into bonds, into government bonds. Now that could also have an impact for gold, of course, because gold doesn't yield anything at all. So gold does fantastically well when interest rates are very low, and when interest rates are very low, it is quite often a sign that there are problems in the economy, and you hold gold because it's safe, but it doesn't yield you anything. So when short-term interest rates go up, there could be a problem for gold too. So that's what Chris Dillow is saying about the US inflation danger. Now that very nicely shifts me on to Michael Mackenzie's long view. Now, okay, we've got the short-term view with Chris Dillow. Now we've got a long-term view. Now, why does the long-term view on the bond market differ any different from the short-term view? Now it's funny, because short-term bond prices, short-dated bonds, are affected by the view of what happens in the short run to interest rates, or the expectation to interest rates in the short run. Long-term bonds are more affected by people's views on what happens to long expectations of interest rates. You know, what's going to happen in 10 years' time, for example. Now, it's interesting because McKinsey points to the fact that bond yields on the 10-year dated bonds are also increasing in the US, Japan, China, Australia, and Europe, and of course the UK. They're at the highest levels in nearly a year. But, and here's the crux, bond yields moving higher from an abnormally low base, which they have been, is really suggesting that the private sector has confidence and a healthy economy is just around the corner, and also the prospects of a growth in profits. Rather than blaming the bond market and expect central banks to step up their support each time, equity investors should take advantage of any drop. So hold a little bit of cash so you can take advantage of any drop in the market. Generally, the trend is for markets to follow the change in profit expectations. And this makes sense really, because why do you actually buy a share? You buy a share because you want a share of that company's profits. If the profits are going up, so too should the value or the worth of holding that particular share. So that shouldn't come as really any great surprise. Now, as I said before, the US Treasury is expecting inflation to be above 2%. So US 10-year interest rates ultimately nearing 3% makes sense, really, given the likelihood of the expansion in the economy. So this is the key thing, because you can always look at history to determine or give you an idea as to what's going to happen in the future. And the absolute crux of this little article by Michael McKenzie is this last paragraph. And that's basically, it says that investors should pay heed to the historical pattern of equity performance versus the 10-year interest rates since 1900. So we've got about 120 years to work from here, which is pretty good going. When bond yields were below 3%, which they are today, stocks thrived as yields rose. So rather than fear the bond market, fear inflation or long-term inflation, fear long-term interest rates, equity investors can prosper from a stronger economy that boosts earning and, yes, results in higher interest rates. And this is what we call a recovery. So I'm quoting Michael McKenzie word for word there for the last paragraph there. We really shouldn't be worried too much about rising interest rates and rising inflation if it is an indication that the economy itself is recovering from what has been a pretty horrendous year in 2020. So 2021, 2022 is going to be, I think, a fairly exciting year for equities. A lot of people are pointing to a possible crash in the US market. That might happen given that the US stock market is are much higher than, say, the UK or European stock markets, but it's going to be interesting. Hold a little bit of cash so you can take advantage of any fall. That's certainly what I'm going to be doing if it does indeed fall, but don't be too worried about the long dated rise in bond yields. Anyway, that's my take on it all from these two articles. I'm not too worried about short-term or long-term inflation and higher interest rates, to be honest. It might just be a good sign that the recovery is well underway and corporate earnings are increasing. So that's my take. Put in the comments below if you think differently and you have a different view on things that I've said in this little video. But I hope you enjoyed it. If you have, please hit the subscribe button and press the like button or things like that. And I'll catch you in the next video. Anyway, I'm Anthony, and as always, we're talking money. But until then, bye for now.